Good afternoon. This is Sean Golding with Golding & Golding, here to continue our series, under 10-minute series. And today's presentation will be a guide to tax fraud. In under 10 minutes, the focus will be civil tax fraud. We'll also go through a few examples. There will be international offshore based. At Golding & Golding, here we specialize exclusively in international tax, offshore compliance. Hence, the focus of the examples will be international tax. Tax fraud, right? So you hear tax fraud thrown around all the time. You hear it a lot of times with tax evasion, although tax evasion is criminal only and typically a felony, whereas tax fraud could be either criminal or civil. Okay. When it's civil, one of the toughest or harshest things about civil tax fraud is that there is no statute of limitations. It doesn't expire. Generally, the IRS gets 3 years or 6 years, depending on the type of violation. With civil tax fraud, technically, they could go back unlimited amount of time. They tend to still stay within that 6-year compliance period, which is why if someone submits to the voluntary disclosure program, which is for people who are willful, not people who are non-willful, then it's 6 years of tax returns and 6 years of FBARs. There's a 75% penalty based on the unreported income and tax implications of that. With civil, the penalty is going to be section 6663. When it comes to criminal, there's all different types of civil tax fraud. Fraudulent conveyance, fraudulent misrepresentations, fraudulent preparation of documents, all different types. But today's focus is going to be civil. So when it comes to enforcing civil tax fraud, there is a clear and convincing evidence standard. So there's 3 standards. There's preponderance of the evidence, clear and convincing evidence, beyond a reasonable doubt. Beyond a reasonable doubt is criminal. Preponderance of the evidence is what you will find most of the time. Even willful FBAR is preponderance of the evidence. There is no direct numerical, but it's typically thought of as just more than 50%. Whereas clear and convincing evidence is typically around 75%. Why? Because when someone gets a fraud penalty, that's a pretty tough violation. It can impact their ability to get a loan. It could impact their ability to get a mortgage or get a job and things like that. So there is a higher standard, clear and convincing evidence. Enforcement for tax fraud is on the rise. The IRS has created various programs and enforcement protocols to go after people who they believe have committed tax fraud. And there's all different types of tax fraud, but some of the main focuses where they think all the money is: wealthy taxpayers who either don't file or they underreport, international taxpayers who may have a significant amount of income overseas, but they're not including it on their U.S. tax return, and cryptocurrency. These tend to be some of the more intensive focuses that the IRS has when it comes to fraud. Since fraud can be either civil or criminal, there's different ways a person can get entangled in a fraud situation with the IRS. They could just be in a regular audit and the agent or examiner is listening to them and they're not buying it. So, that could lead to potential referral to a supervisor, potential referral to the IRS special agents. Right, and then the IRS special agents may come out and want to talk to the taxpayer. Then, depending on what they think, it can either be a civil penalty and or possibly referral for criminal enforcement. So civil fraud is kind of high up there on the enforcement priority for the IRS. It could be civil, it could be criminal, and so taxpayers who are in this type of situation need to be careful. When you're dealing with your typical audit, it'll be referred to either as an eggshell audit or reverse eggshell audit. We have some information on that on the website. An eggshell audit tends to be when the taxpayer knows of some information, they're in an audit, they don't want to give it up. You got to be careful. You don't want to do an intentional omission, but at the same time, you're not required to give all the information if it's not something that they're asking about. Reverse eggshell audit's a little different. That's when the IRS has the information. You may not know that. Common situation, international related, is FATCA. Maybe your foreign financial institution reported you to the IRS. The IRS has this information about the foreign accounts you think no one knows about. You're filling out your tax return and you're not including this information in there. The IRS agents may double down during the audit and start asking specific questions about that, even though they know you haven't reported. Then the taxpayer may double down and say, "Oh, no, I don't have any accounts," even though the agents clearly know you do. And that can lead to a fraud situation and even worse. So some common examples, okay? There's lots of different examples. when I'm giving you these common examples, it's important to note that these are just based on general facts. Everyone's facts are different. They can be very similar, but they're different to some extent. And so even small facts can have a big change, a butterfly effect, in whether someone is willful or non-willful, whether it's really fraud or if it's just negligence, things like that. So just because your situation may be similar doesn't mean that you're in the same boat necessarily. So one situation that's been coming around lately is providing false information to a foreign financial institution. So Taxpayer is a lawful permanent resident. They are living overseas. They want to open some accounts, and they go into the bank, and the bank goes, "Oh, are you a U.S. person?" And you go, "Well, I know I'm a U.S. person because I'm a green card holder, but I'm not a citizen." And even though they're not directly asking whether you're a citizen, and you understand what they're asking, right? They're asking whether there's going to be a withholding or reporting requirement because you're a U.S. person. If you tell them no, for example, and then you give a foreign ID instead of showing a U.S. ID or acknowledging that you're a U.S. person, that can be a form of fraud because they could see it as you're knowingly not giving the information so that they can't report you. Willfully excluding income. This is common, right? Taxpayer has Taxpayer has income being generated from overseas. It's in a country maybe that doesn't have a treaty, or it's income that's not related to like a foreign bank or a foreign investment account. So the taxpayer thinks that there's no way the IRS could know, and they intentionally exclude that the earnings on their tax return. That could be considered a type of tax fraud. Willfully excluding bank accounts. So I'm cautious when I'm saying willful because if it's a mistake, if your facts are the same but it's a mistake, then it's not fraud, right? But let's say you've got 8 accounts worth $3 million and you think you're going to be leaving the U.S. soon. So you think, you know what, I don't want to report this stuff. I mean, I know I'm supposed to report it. I've had a CPA in years past. I know about FBAR and I know about FATCA, and I know I'm required to disclose it, but you know what, I'm not going to. That's willful, right? And that could be considered a type of fraud. And then fraudulent conveyance is also something that people try to get away with, and sometimes they do, but if they don't, it can be considered fraud. Example would be, let's say you own a grantor trust with other foreign family members. They're not U.S. person. You go, I don't want to report the income because grantor trust income is usually taxable to the grantor. So taxpayer goes, you know what, I'm going to give my share to my sister so that she can collect the money and then she'll transfer that money to me. Taxpayer didn't really give the shares to the sister, right? Just doesn't want to be caught getting the income. So it's not really a transfer. It's just an attempt to hide the money. And so if the IRS finds out about that, that could be considered a type of tax fraud as well, because it's intentionally giving the impression that you've already given away the assets, but collecting income being couched as a gift from a family member, and that could be a problem. So if you are fraudulent and you haven't been contacted by the IRS yet, you would consider the Voluntary Disclosure Program, VDP. That's for people who are willful. But just because you're concerned or you're scared or you spoke to some fear-mongering attorney that made you feel like you're willful even though you don't think you are, you don't want to jump into VDP and send over a pre-clearance letter and get entwined in all that if you don't really think you're willful or you're not sure. Because if you're non-willful, there's lots of different programs available. There's the streamlined procedures, there's the delinquency procedures, and there's reasonable cause. And you should speak with a board-certified specialist or multiple board-certified specialists before taking the plunge into VDP. And if someone says they're certified, you should ask them where they're board certified in what state. Because even if they practice federal tax, they still have to be licensed by one state bar as being board certified. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.